So I guess what I'm saying is that stocks might have found a short-term bottom here. What is going on, traders? Welcome back to the Traveling Trader. Feels really weird being in this studio environment after not having been here for 2.5 months. That is not why you're here. You're here because you clicked on the video. The title was something like, "The recession will be long and painful, but stocks might have found a bottom." So allow me to explain. This is very nuanced. A lot of you that click these videos understand the nuance of the markets, but a lot of you that click these videos say, hey, you're changing your mind every 5 minutes. It's not that you're changing your mind. It depends on the time frame with which you are discussing the markets. Also, with new information comes new opinions. So here's what I'm saying. I'm saying that obviously, if you guys are in tune with this channel, you know that the FOMC, the Fed meeting, is coming up September 21st. They are likely going to do a 75 basis point rate hike, the third back-to-back 75 basis point rate hike. We're going to discuss what that means for the market, why a lot of this might be priced in. We are in a technical recession if you're going to count a recession as two negative back-to-back GDP quarters. But remember, the stock market is forward-looking. So a lot of this stuff is already priced in. The 75 basis point rate hike for September 21st is already priced in. And we are seeing this typical double bottom pattern on the triple Qs and on the SPY, where the second bottom is not quite as low as the first one, which I'm going to definitely get into. Also, we do our TA Tuesdays and Thursdays, so I'll get more in depth into this on Tuesday or Thursday of this week. So I guess what I'm saying is that stocks might have found a short-term bottom here until at least December, and I'm going to go through why that is and how to play this. We already bought calls on the triple Qs this morning, the 295 calls. I actually also sent this out on Twitter. Follow me on Twitter and Instagram. I do free finance content almost every single day. We closed these for 42%. You could see those alerted here. I was going to hold them overnight into the FOMC meeting, but I think I'm going to open up a play on the FOMC day on Wednesday. And I'll tell you what happens each and every single time during the FOMC meeting so that you could potentially take some lucrative trades if you so decide to and you agree with my analysis. And if not, that's cool. We can agree to disagree. Let me know your thoughts in the comment section below after you watch this video. And before I get into it, we have a few spots left for September. So make sure if you want to apply to be part of the Academy, sign up, book a free call with an ambassador, and apply before spots fill up, and we lock them again until the next month, which is, October, until October. So link is in the description. Hit that if you're so interested, and let's get right into it. All right, so as I said, it is very common for the triple Qs to make this double bottom pattern where the second bottom is not quite as bottom or as low, as the first bottom. You can see this here going, I mean, if you're familiar with the triple Qs, you can see this going all the way back, scroll as far back as you want, but you see one here in 2018. You obviously see it here in 2019. You see it here in 2020. You see it here again in 2021. You see it right now in 2022, right? And let's just analyze what we have left until the end of the year in terms of catalysts, obviously barring any sort of black swan events. Well, we have the FOMC meeting coming up September 21st, which is a Wednesday as of the time of this recording. 82% chance of a 75 basis point rate hike. And Jerome Powell has been telegraphing this really for the last month and a half. Remember, we didn't have an FOMC meeting in August, but he did that Jackson Hole meeting where he basically used it as an FOMC meeting and said that the Fed is going to get as aggressive as possible. So 82% that the Fed does a 75 bips rate hike, only 18% that they go a full percentage point or above. Now, the one caveat here is if they do a full percentage point, which I don't think they will, there's really no incentive to do that. But if they do a full percentage point, then I think all this analysis goes out the window, and we actually do see the market revisit the June lows at least. But ever since the Fed started getting aggressive, you can see here, shout out to our analyst, Dr. Flox. He's one of the analysts on the Discord, but he basically put this chart together, the simple chart that outlines the last FOMC meetings and how the market behaves. First and foremost, During the FOMC meeting day, the actual day itself, the market always rallies. For 2022, this has been true of every single FOMC meeting in 2022, that after Jerome Powell shuts the fuck up and stops talking, the market rallies, because at that point, most things are priced in, at least for the short term, right? However, you can see here, this is the 75 basis point rate hike. The market found a bottom in June. Another 75 basis point rate hike in July. The market continued to rally. So because we don't have any catalyst between now and November, right? November, remember, there's the election, there's the next earnings season, and we also have the FOMC meeting. We don't have one in October, so you have a month that is free from the shackles of the Fed, and the next FOMC meeting is November 2nd. So between now and November, you really don't have any market catalysts, and if everything is priced in, that can set the stage for a short-term bottom. Now, I'm not saying that everything is rosy, so for those of you panic dwellers and fear merchants, don't get your panties in a bunch. I still think we are on the cusp of a recession. And I actually think that after this FOMC meeting, after the Fed does a 75 basis point rate hike, that this right here, the 10-year and 3-month, which has inverted every single time before a recession and has actually been a better timing predictor of a recession than the famous 10-year, 2-year treasury, right? That one just alerts that a recession is coming, but it could take up to 2 years after that yield curve inverts before a recession happens. However, the 10-year, 3-month, you could see here that when that inverts, a recession, which is highlighted here in gray, is very close by, right? So the minute that that inverts, the 10-year and 3-month, then I think we will be on the cusp of a recession, probably around 2023, which is not a novel opinion. That is a rather popular opinion at this point. But after this Fed rate hike cycle, because remember, the Fed funds rate is actually a short-term interest rate effector, right? The Fed funds rate doesn't affect long-term rates directly, right? What affects long-term rates is really the supply and demand of the bond market, but the Fed funds rate directly affects short-term rates, and primarily the 2-year, but also the 3-month, the 6-month, etc. So the 10-year 3-month has been a much better predictor of a recession, and I think after this 75 basis point rate hike, you will then see the inversion between the 10-year and the 3-month within a short amount of time, within a few weeks or a few months, and then we will be on the cusp of a recession. So keep your ears and eyes perked for this 10-year, 3-month inversion here. You can find this on the Fred website, which is actually run by the Fed itself. Now, let us talk about why the recession can actually be long and painful. I took a look at this research from the Macro Compass on Substack, and this actually is very eye-opening. I love when I see people or institutions put together research like this that compiles historical data in a very concise manner. So this is what happens after the CPI or inflation in the US hits above 3%. Remember, 2% is the accepted inflation rate. We could talk about why that is. I'll get into that maybe in another video, or again, you can follow me on Instagram and Twitter for free finance content. But anything above 2% is considered high, right? So anytime that inflation was above 3%, that CPI was above 3%, it actually took a recession for us to bring that CPI back down. Now, 3% doesn't seem like a worst case scenario, but again, this compiles all of the times that CPI was above 3%. And you could see that each and every time it took a recession for us to actually bring that inflation down. So when inflation is above 3% and we enter a recession, it took an average of 16 months for CPI to come down to 2%. Now, 2008 is not a good parallel, neither is 2001, even though those were two of the worst recessions, two of the three worst recessions we've ever had in the US, short of the Great Depression, right? 2008 and 2001 were two actually Great Depressions of our lifetime. But if you take a look at when inflation was really high, so close to the double digit mark, 1948, 1974, 1981, And this is the highest inflation we've had actually since 1981. You could see that it actually takes quite a long time for CPI to actually come down to 2%. 1981 took 41 months, and that took Paul Volcker raising the interest rate, the Fed funds rate, to 20% before inflation actually started moving downwards. 1974 took 24 months. 1948 took 11 months. And I don't even know if we can even compare that to, I mean, it might be so long ago that the conditions are not comparable, but it is data that we can use. So on average, it took 16.2 months to slow inflation down to 2%. And it took a recession to do that. Now, the Fed may not want to admit it, but they know that they have to actually force the economy into a recession through rate hikes and through selling assets off of the balance sheet. They know that a recession is coming. They just can't say it. But to Jerome Powell's credit, it might be, too little too late. He did say that they're willing to do whatever is necessary in order to bring inflation down. So unfortunately, that entails rising rates in an economic slowdown. And remember that the effective Fed funds rate minus the CPI, this is the most negative that we've ever been, even more negative than those periods we talked about, 1975, 1981. This is the most negative we've ever been. So it might even take a much bigger job to make sure that the Fed funds rate is above CPI, to make sure that we actually have a positive Fed funds rate, right? So in terms of trades, a lot of people thought that I was crazy for buying calls on a day like today. Again, this is Monday, September 19th, because the market, saw a 7% drawdown last week. However, this is the week of the FOMC meeting, and if there was going to be any relief, it was during a week in which everything was priced in. So I could have held those calls, closed them for 42%. However, on Wednesday, September 21st, I will likely wait for any sort of retracement. I'll look at the intraday chart, wait for any sort of retracement, and then likely buy calls on SPX for the PM session. Really depends on how we open. If we get major drawdowns on Tuesday, September 20th, then I might buy the calls towards the end. Obviously, if you guys are in the academy, if you're on the Discord, then you will know my plays in real time. But if you're familiar with this channel, you can go back and rewind the tape. I don't have to bullshit you or bullshit anybody. You guys know that we actually bought puts when we completed this fractal, the same one that we did back in March and April. And we closed those after the market started bouncing up here towards the first week of September. And now I'm not opening bearish positions until at least after the FOMC meeting, but I will likely be playing calls on the day of the FOMC when Jerome Powell stops talking and everything is priced in. But there will only be day trades. I'm not really going to hold these things. There are also some really lucrative cash secured puts that I might send out. On Amazon, for instance, you could sell the 100 cash secured put expiring in January for a good amount of money. Microsoft is looking super juicy here at the May 2021 lows. Might sell a cash secure put on Microsoft and even buy shares on Microsoft. But again, tune into the Discord for my live plays. I would much rather fade the market, play along with the smart money, buy stocks when they are cheap, or at least sell puts when the stock market is cheap, and then sell into these rallies. Right now, the triple Qs are almost 30% down from highs, so I might nibble on that a little bit as well. So long story short, I think the market might have found a bottom only in the short term. I do think a recession is coming, and I do think that recession will likely create a very choppy environment in the market. And we will likely break those June lows at some point, depending on how broad-based the recession is. Again, if the Fed does a full 100%, a full 1% rate hike or 100 basis points, then I do think that all of this goes out the window and we will likely see lower lows on the stock market very soon. But I don't think that's the case because I don't think that the Fed can actually achieve something with a full percentage point rate hike that they can't with a 0.75% basis point, 0.75% rate hike, especially since it'll be the third 75 basis point rate hike in a row, the most aggressive the Fed has been in 40 years. I do think they will likely pause in November right before the election, giving some excuse that they want to see how those rate hikes and how the balance sheet runoff is going to affect the market. They want to give it time to see how it's going to affect the economy, not the market, sorry. And I do think that October CPI can actually come in line with estimates, maybe a little less since prices are dropping. And that will give them an excuse to pause in November or do something very tepid like a 25 basis point rate hike. But right before the election, I don't think they're going to go aggressive. So they might pause or do something very small here, which again would give the market some short-term fodder. Anyway, traders, that is it for this video. If you are watching this and you are not subscribed, hit that subscribe button. We put out great content. You know it. I know it. Just subscribe. It's easy. Click the button. Also, if you disagree with this, leave a comment, please. I love engaging with you guys in fruitful discussions, and we can have a engaging and respectful discussion in the comment section. So leave it down below. Again, we have a few sign-up spots available for September before they are done, and we will likely open up spots in October. So if you want access to my live analysis, the trades that I'm making, the analysis of the analysts that we have on the Discord as well, you get access to the day trading course, the options course, the Zoom calls with me, all of that good stuff. Link is in the description below. Book a free call. It's free. Just book it. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.